Well, of course, there are fears that stage 6 rolling blackouts could pose a real threat to South Africa's economy and our sovereign credit rating. It comes as consumer confidence, it has been revealed, has dropped to almost an all-time low. The FNB BER Consumer Confidence Index plunged to minus 25 in the second quarter of this year. Now, FNB says the reading has not been this low in more than 3 decades, barring one quarter in 2020 when the sudden outbreak of COVID-19 prompted that level 5 lockdown. Economists are now warning that a reading this low could possibly mean a recession is coming. To discuss, we're joined by Chief Economist at Investec, Annabel Bishop. Thank you for being with us, Ms. Bishop. FNB saying this drop in consumer confidence is alarming. Do you agree with that?
Yes, it is very alarming, but I think we need to see it in the context that it comes in. And of course, it does reflect the fact that the second quarter of this year obviously experienced very much higher interest rates and, of course, particularly higher inflation. And if we look at, the actual reading itself, we can see that all income groups in South Africa saw a substantial loss in confidence, consumer confidence, but particularly your higher income groups. And this is attributed partly to the fact that we actually saw a lot of risk aversion take place in financial markets in the second quarter of this year. You recall we saw the United States hiking its interest rates, and of course there was a loss in share value on the JSE around the world itself. Perceived risky assets, shares obviously fell. We also saw currency weakness as well. So many factors contributed to this, but of course let's not also forget the higher fuel prices and of course as well the load shedding.
This was before stage 6 was announced, I believe, though. So we could be looking at a compounding effect in future.
Well, I think that's the concern. Look, luckily I saw today, and I hope it's true, that stage 6 is now ending at 10 o'clock tonight. And tomorrow we're going to be going into stage 4 and intermittently stage 2. Of course, still terrible. Even any load shedding at all negatively impacts economic growth. And of course, some of the key reasons why we saw the weakness in this consumer confidence reading that came out today for the second quarter is, of course, as well, fears from those surveyed across the board about further economic weakness, concerns that the economy will actually see substantial weakness, and of course that consumers don't believe now is the right time to actually start making purchases. So, and that's of course particularly on durable goods, not on essentials. So this is very concerning because, as you know, consumer spending in South Africa accounts for 2/3 of GDP.
So let's bring up the graph released by FNB itself. And of course, one of the pertinent questions is, could people be overreacting or be overly pessimistic? Maybe they will go and buy, the economy, the wheels will keep turning. Or could this actually mean a coming recession, given what we were talking about, the extra compounding things? I mean, petrol is going to continue to go up, etc.
Well, a recession is 2 quarters of contraction at least that follow each other. And of course, the second quarter is already at risk of a contraction because of those devastating floods we saw in KwaZulu-Natal in the month of April. And while today's figure on its own doesn't itself signify that we're necessarily going to fall into recession, there's a concern globally that the global economy could see recession. This might not necessarily happen this year. It might take place next year or the turn of this year into next year. But that, of course, comes on the back of very high interest rates expectations. The United States hiking its interest rates already and expected to hike significantly more. And in fact, given that inflation is very high globally, the US is hiking its interest rates to curb high inflation. But of course, the concerns are that it's not going to be enough, and they're going to need to push the US economy essentially into recession or close to recession if they want to actually make a dent in the high inflation figures, get them down to the 2% that they target indirectly when consumer price inflation in the US is obviously above 8%. Of course, in South Africa as well, high inflation, it's now above 6% and likely to go above 7% in the third quarter. That cuts into real disposable income in South Africa, but of course, so too do interest rate hikes.
Ms. Bishop, the graph we bring up now looks at the different sort of income groups or the different earning levels. You say that everybody is pretty pessimistic, but if you look at the wealthy, the middle income earners, they are especially pessimistic. They are even bleaker about our economy than low-income earners. Just explain that discrepancy. You would think that the people earning less would be bearing the brunt of the higher petrol prices, higher food prices, and be feeling very squeezed right now.
Well, I suppose if you have a look at debt in South Africa, the majority of debt is held by the higher income earners. And of course, higher interest rates is a particularly negative hit for them, as of course is the weakness in the stock market, holding equities as well. But of course, what's particularly concerning is the fact that we obviously are expected to see the economy weaken substantially, perhaps go into recession. And, the second quarter did see, during the second quarter, some temporary halt on the social distress relief grant. And of course, that's now been re-implemented in the recently. But of course, that in itself also would have caused some negative impact to low-income earners. But returning to the high-income earners, in previous consumer confidence readings, we saw the high-income earners not necessarily lead the drop in confidence. And of course, perhaps now they're catching up, but also very aware of the fact that that we talked about earlier, the global economy could fall into recession. And, that I think would be something that perhaps your more financially literate people who follow the financial markets would probably be aware of quite quickly and might be depressing confidence. Now, it also particularly talks to the fact that the figure overall, the consumer confidence figure today, talks to the fact that we might see lower expenditure going forwards, again hitting many in the affluent group who perhaps own companies or work in large companies that are consumer facing. So I think it's many different factors that have resulted in this poor outcome today.
Yeah. Very quickly, we're running out of time, but add to this stage 6 load shedding, stage 6 rolling blackouts, very low consumer confidence already recorded. Does that mean we're going to see a credit rating downgrade and everything is just going to get tougher all round?
So not quite yet. So let's not become negative about everything. The good news is that the credit rating agencies purely rate us on the back of our debt, both actual and perceived debt, or in other words, the likelihood that we have to repay that debt, and of course as well on our fiscal deficits. They're part of the parcel, but really they look mainly at our ability to repay our debt. Now, given that the economy is obviously seeing quite high inflation, that in itself tends to deflate debt, reduce it somewhat. But also, of course, if you look at it as percentage of GDP, again, in nominal terms, because you obviously get much higher nominal GDP growth rates under high inflation periods. But of course, all of that aside, government has actually seen better debt figures coming through this year. And in fact, our credit ratings are mainly on positive outlooks or neutral. So they're not on negative outlooks. Of course, the load shedding that we saw, particularly the stage 6 load shedding in reaction to inability to effect repairs and maintenance, and of course as well the strikes that happened recently from many electricity workers. All of those factors have been temporary because obviously we've seen that stage 6 load shedding has ended today. Of course, if it doesn't end, if it persists and becomes quite lengthy and happens for a few months or more, the credit rating agencies will look at that impact on the economy, on the ability for taxpayer revenue to come in and fund the debt and deficit. So that's really where we are at the moment. The load shedding has not been enough to damage government finances. It's not expected to have an adverse effect on credit ratings views of South Africa, the credit rating agencies, but there is a risk if load shedding continues at level 6 or gets worse.
All right, so it's bad, but not all that bad yet. Thank you very much, Investec Chief Economist Annabel Bishop.